Welcome to Thursday's session dated August 26, 2021. Please note that these videos are for educational purposes only, not to be taken in form of advice. Past performance and indicative of future results. And if you need to know more, please visit our website at www.esttrader.com. So I'm going to discuss three things. But before I'm going to go and discuss it, do you have any questions, queries, challenges, comments, or anything you want to ask before I begin? I'll start from you, Daniel.
I'm good, thank you.
You're good? Cool. Jeff?
Yeah, I'm good.
Awesome. All right, I will use the dollar CAD as an example for what I'm going to discuss today. So, there are different types of trading. There is momentum trading, scalping, day trading, swing trading, investing, but there are also different types of styles of trading. Some will use just pure fundamental analysis. Fundamental analysis, you're going through your profits to earnings ratio, profit to loss ratio, looking at the company if you're trading stocks. And if you're trading futures or you're trading, say, currencies, then you're looking at more of the macro global fundamental or macro global economical fundamental analysis component of it. And then there are what you call technical traders, people who just use technical analysis and systems that uses indicators in part of their technical analysis. And I believe there's three different components, and the other one is basically we call trend followers. After going through, after like 20, I don't know, this is my 26th, 27th year of trading, and then going to the floor as an observer, basically in the past, and learning from others as well, I became more of a professional observer that is a trend follower. So I'm a trend follower that follows the trend of the markets. When I say the markets, it doesn't matter whether I trade stocks, forex, futures, with the exception of options, because options are a different ballgame. And through there, I changed my whole style of trading, because going to the trading floor, everything's about price and everything's about supply and demand. So technical analysis is just part of the equation. So there are three different components in terms of, let me actually put it here, three factors or components when entering a trade. Let me delete this one here for a sec so we can have some room. And what are they? Actually, just to test you guys out, what do you think are some factors or components that when you're trading, what are you guys looking for? What do you have to do for you to enter a trade? Mind you, there is no right or wrong answer. I'll start from you, then Jeff.
Well, when I look at the a chart, I usually look at the support and resistance. Like there's certain levels that I have an idea of where I'll be looking to get in if it supports it. So and then also I look at the price actions, like you know, just price action, and then the dollar, the volume. What was that? It's like the dollar volume, that is dollar amount that's flowing into the index, the S&P 100 index.
Okay, cool. What else?
That's basic. yeah, that's basically it.
All right. Okay, great. Daniel, how about yourself?
Yeah, I'm also with support resistance. You call it supply and demand. I think it's essentially the same thing. What's the trend? Is it bearish or bullish? Yeah, good questions. I know you like to look into macro fundamentals a lot. Yeah. Actually, that's everything I can come up with at the moment.
Okay. So all these are simply, okay, everything that you guys basically described. Is what we call technical analysis. And the second one, actually they go in order. Fundamental analysis. And then the third one is the psychological tone that has been named by one of the best traders. His name is Michael Marcus. So if you Google him, he was one of the main guys that got interviewed by Schwager with what's the name of the book again? Market Wizards. That's it. So technical analysis alone, based on this, won't cut it because it's not enough. Fundamental analysis alone is not enough either. It's the combination of technical analysis and fundamental analysis is where it lies with the most important part, which is the psychological input based on news. Why? Because, let me add here. News plays a very big role in the marketplace. With no news, everything that you stated here will be useless. There's no price, actually price won't go up, won't go down. There is no, the volume won't go up or go down. There's no trend, and your support and resistance will be useless as well. And news plays a very big factor with everything. And this is where something I basically, being an observer of the trading floor, made a really big difference, because prior to anything, any movement like this one, anything that has dojis in general, they have meaning. And this is what makes it really challenging for retail traders, is that if you're only learning technical analysis based from a book or from someone who is teaching patterns, but they don't fully explain what they do mean, and you don't have the visual component of it because you've never been, or you've never seen how price is actually really being created, or how the dynamics of buying and selling that create supply and demand really operates. And that's what really, really makes it challenging. And hence, that's why pattern traders will also struggle, because they only look at patterns, but those patterns also mean something. But deep down inside, everything that you see fit here, from a bearish candle to the definition of a gravestone doji to a definition of a hammer, they mean something behind the scenes based on two players who's playing the game between a buyer and a seller. but based on supply and demand, no more, no less. That's why your support and resistance, I changed my whole definition and my own meaning from support and resistance, because in my opinion, this doesn't mean anything unless you know what it means. And if you don't have those meanings, or you don't understand what it means, it's going to be a struggle. And you're going to be a lot of losses than actually wins. So this trader, Michael Marcus, which you can Google, or if you haven't read actually Market Wizards, I highly recommend it too, even though it's an old book, but you can still learn a lot from it. I know that the market sentiment, or the market in general, has changed compared to the trading environment in the 60s, 70s, 80s, 90s, and even early 2000s, compared to what we have today, where you have a lot of volatility. Everything's all computerized based, algorithmic based, and it's even more challenging right now because you're now competing against computers that are really, really smart, and also a lot of information, where you're also competing against institutions who have all the resources and fast computers that have a picosecond in terms of instantaneous news ahead out of everybody. And then we as human beings, as retail traders, all of a sudden we have human emotion, and we're no longer being objective because of cognitive biasness based on our own perception. And once we have that, it becomes really, really challenging when it comes to trading, especially you're dealing now with short-term time frames. And if you don't know your trading style, actually, yeah, a couple of weeks ago, I did a webinar about market profile. Knowing your profile, knowing your style based on your own profile. And if the system that you're using is not in synchronicity with your personality profile, then once again, you're screwed. Of course, at the end of the day, the goal of a trader is to be adaptable in any time frame. However, it is also the mix and match of time frames with knowing the psychological tone with it. And if you don't know the psychological tone based on the time frame that you're using, that you're dealing with, you're going to have a lot of problem once again. And hence, that's why anybody can make money in any market conditions in any time frame. One will be short, one will be long. That's why if someone says, I'm short, but if you're not asking specifically which time frame you're using, then that will also have an input in terms of your own opinion, because someone is saying, oh my goodness, he's shorting, or he's short, without asking, okay, which time frame, because you might belong on a bigger time frame, but he's short on a shorter term time frame. So both people can make money. And hence why in trading, there's no right or wrong. Where the errors happen is from the emotional component, not enough evidence, because they're trading based on their own biasness and what they see fit. That's why these three factors plays a very, very big role. Technical analysis is only a very small portion. Fundamental analysis plays also a big role from it. And then knowing what the news or how the trend is actually going. As well as a trend follower, it is really important to know the bigger trend. And then from there, you would be able to dictate where and when, if that you choose to short from a bullish move, like say here, you're shorting from a bullish move, you only have the amount of distance that you can cover. But if you're now being greedy, remember there's two emotions of fear and greed. But if you're saying, no, I want my target point to go at 124.50, it won't let you. Why? Because it is in an uptrend. So another example with the pound against the US dollar, from what we entered here, really good price, 136.25. It's at wholesale price point, can't really get it at institutional price point, at manufacturing price, but close to almost manufacturing, low risk, high probability, and you only have this distance and it has to cover. Can it go all the way up here? Yes, it can. However, the markets, there is a terminology called limit up or limit down. Limit up simply means the amount of bars that it can go to a certain limitations. Limit down is the amount of down days that it can create within a particular time frame. So certain patterns will also basically work. Certain distances will also work. Rather than going through patterns, actually, is knowing in an advanced level, there is a technique or a strategy to define how many pips or how many points it can go to the upside or to the downside, even on a correction component. So from a correctional standpoint, you will know how many pips or points it will go, and you will know approximately how many limit ups or limit downs it's going to do in order for that to continue. So let's say, for example, here, it is all based on your Fibonacci retracements. So if you're using fibs are really good indicator or tool to define approximately where price is going to correct depending on where the impulse is going to happen. Mind you too, though, based on experience, a lot of, especially novice traders, they will take the number as a really defined number. So in other words, 37.47. It's almost like, okay, that has to be the solid number where I'm going to put in. But it's markets itself or trading in general is an auction house. There is a plus or minus. It can go beyond 37.47. It can go below 47.7. So based on experience, either sometimes if it's say on a downtrend, then I will put it way below the fib. But if it's in an uptrend, then I will put it above it. And then I will just basically trail it, and then to have different strategy in terms of money management, like an 80-20 rule, 7-30 rule, 70-30 rule, 60-40 rule. So you can create whatever money management strategy that you can create from there, that just in case if it goes to the opposite side, then your risk is actually zero and your reward is infinite. In actual fact, you're already taking some money out of the table, because at the end of the day, what is the goal? The goal is to make money. And yesterday's discussion is that righteousness doesn't play or doesn't give you any benefit. That's based on experience. Because sometimes, especially for myself, is that if I'm being righteous and my ego or righteousness kicks in, and I'm no longer thinking about the money, it's because of I want to be right. I want to win. I am not going to cut my losses short. I'm going to just let it be. It's not really the best way of doing in terms of trading. And this is also something that a lot of really good traders, professional traders, it doesn't matter if they trade their own money or they use money of institutions, especially if you are, like say an institutional trader, you trade for a company, you have no choice, right? You have to follow certain rules. But when you have your own account and you are your own boss, you can disobey your own set of rules based on your own ego. So if you cannot control that, then you're screwed, basically. That's the bottom line. All right, so it is this, so from the pound against the euro was an example, and hence to get out when something is no longer, and you can also see it in actual fact from the size of the bars, the size of the candles, and then through there defining approximately the distance of how much is already covered, then it's better to get out, close majority of your positions or close out all your positions, and then buy back in again when it's time to buy back at a cheaper price at demand. And here's one problem that I always see with retail traders, especially novice ones who use support and resistance. No offense if you're using support and resistance. People use support and resistance just to define where the limits or depending on where they're at. But in most cases, that if, say, for example, you're buying at a certain price point at retail price, because you're using indicators that will get you in at the retail price point, and your target point is beyond that resistance point, then you're not going to make any money. Why? Because resistance simply means that's where sellers are resisting price points, especially when there's going to be a lot of pressure. When there's a lot of pressure of sellers resisting it, and then you want a price that is more beyond what you want, when the market's not going to give it to you, then you're going to be in trouble. Then basically you're screwed. That's why always put your target points below that supply level, or if you're shorting, put it just above the demand level, unless it really breaks it out. But in order to break something, you will need news in order to do so. So 3 components. Technical analysis is basically the study of price movement or price action to forecast future price action or price movement using present and past price action or price movement. So it's really imperative for you as well to define what technical analysis is objectively, because if you don't know the definition of technical analysis, then at the same time, you're also going to be very subjective, and you don't want to do that. So the technical analysis component is simply the use of price action, and then defining, utilizing your indicators, your support and resistance, if that's what your gig is, and then using volume and all of that. But it's a combination of everything. But you cannot just go into the markets using technical analysis alone. It's not enough, unfortunately. The other one is fundamental analysis. So if you're trading stocks, then it's imperative for you to do a lot of research with the company that you want to get into. And this is why Warren Buffett is so good at what he does, because he knows exactly what to look for from a fundamental analysis perspective. He doesn't really use technical analysis. He's just a pure fundamentalist. And then from there, he traded options. Warren, if you want to read about his biography, that's how he became really popular, or the way how he does things and became a billionaire is simply the way how he read those numbers. And he knows whether if the business is doing well or not. If it's not doing well, he will buy distressed businesses, get into the stock and so forth, like Coca-Cola and Dairy Queen, for example, right? And Coca-Cola bought DQ. So knowing your fundamental component is very important. As a currency trader, a futures trader, I trade stocks, but no longer stock, but mainly ETFs. It's just a lot of work. So unless you really love all those, then definitely like trading stocks, then you have to go through the fundamental component of it. But as a currency trader and a futures trader, then I need to know what the fundamentals are from a macro global component, whether if they are in synchronicity with everything. Let's say for the dollar CAD yesterday, I already know for a fact, because I look at the markets on a daily basis, oil has been saturated. Oil is basically on a downtrend since July. Can it go beyond 270 and around this year? For sure, definitely. But after 3 days, or its limit up has limited already and already went up. And you can see here from a stability perspective, when something stabilizes itself, and you can already see it here, notice the size of the body. It's like driving a car, it's slowing down, it's running out of gas. When it's running out of gas, it has to stabilize, it has to refuel before it can continue once again. And then we also look at the dollar index, same thing. Correction is finished. It is within the trend in terms of its psychological component, and this is also how you can define, or you can look at news with trend. It doesn't matter whether if it's going to be a positive news or negative news. If it's negative news, markets will still, normally the probability that it will keep going is more than likely to happen even with positive or negative news. So here's a good example. You see it here as a preliminary GDP as 6.6, which is 0.1 lower than the forecasted one. However, 0.1 higher than the previous number. And the preliminary GDP is higher, 6.0 now to 6.1. Unemployment claims, 345 to 353. So is that a good sign? Yes, because simply that means that there's a reduction of unemployment, right? So here, if I go through the 1 hour prior to the news, and then now the news, after the news, it came back up again. Why? Because from a psychological component on a bigger perspective, it's an uptrend. So whoever is pushing the price whether it's a hedge fund or could be one big institution. So they're pushing that price, and notice the amount of volume that basically has been put into place. So, but the prices are also at supply, created currently at the peak at this point. Someone was willing enough to sell lower compared to these previous lows for the previous days. So it'll be very interesting at the end of the day, whether if, from a psychological perspective, whether sellers will come in and buyers will leave the game. And volatility index, per what we also dictated, that from a demand perspective, the odds and probability that we'll fill in this gap once again is more than likely to happen. So there was a lot of volatility, a lot of fear at the very beginning, and then all of a sudden, there's no more fear. There's some form of certainty of what's happening based on the volatility. So that being said, if really need from a macro fundamental perspective, so what is this macro fundamental that causes the price to go up or down is through all this news. That's why as a trader, it's also important for you to know the macro global component in terms of its connectivity against each other. And mind you, they're all connected. Technical analysis alone won't cut it. So that's why to create that the odds that this is going to go up rather than going back down is highly probable from this perspective, especially when you have two dynamics of buying and selling based on supply and demand from a point of equilibrium, or when things are equal. No one's buying, no one's selling at the from opening to closing. However, from what it dictates from a high to the close is that there were some form of buying pressure at one point, and then a lot of selling pressure basically in the end. That's how dojis are being formed. Like this one, it was really solid, and then all of a sudden buyers disappear. There were a lot of buyers on this side. They pushed the price all the way to 29.50. Everybody took their money, and then buyers disappeared, sellers did come back in, and that's how gravestone dojis work. They got all scared because from this component, if time wasn't a factor, this will keep on dropping unless someone will be supporting that price point, hence the terminology support. So to know all of these plays a very big factor in what's causing for the price to drop. Prices are dropping because of oil that is also increasing. So what is connected with oil? The Canadian dollar being a base currency. So if oil is going up, then it's good for the Canadian dollar, because one of the major imports of what Canada does or exports is actually oil. So if there's a demand for oil, then the price of the Canadian currency will go up. But if it's depleting, then the price of the Canadian, or the value of the Canadian dollar, will also deplete, and hence, and it's connected with the dollar, and it's also the dollar index, and the dollar index is going up, and there's now the weighted mean between those two. So there's the power has been the two plus, and if you can add that within the psychological component of fear and greed, and dictating what the trend is, then you will have the highest probability of winning, and you're going to have more certainty and security when you're entering the trade.